Now it is 2 minutes past the hour. I am very happy to see so many of you joining us. Once again, welcome to the IEU Virtual Talk. My name is Iben Hjorth, and I am a communications consultant at the IEU. I will be moderating today's talk. Now, sustainable financing is something that speaks to the challenge of our time, really, climate change. How can we reshape incentives in the financial sector to reward not just profit maximizing behavior, but also doing good for our planet and the people on it? That's something that we take a deep interest in at the IEU, and that is reflected in the topic of today's talk, which is the future of climate bonds. I have personally followed this topic for a long time, and it's been very interesting to see the field continue to develop and to see the issuance of both green and most recently social and sustainable bonds keep growing. Now, our speaker today is Mr. Sean Kidney, CEO of the Climate Bonds Initiative, or CBI, and he will be joined by our discussant, Dr. Jyotsna Puri, who is a director at the International Fund for Agricultural Development, or IFAD. Now, for a bit of housekeeping, kindly mute your mic during the presentation and when you are not speaking. We encourage you to submit your questions through the Zoom chat box during the talk. We will try to get to as many questions as time allows during the Q&A session. If you instead would like to ask a question directly, you are welcome to use the raise your hand button during the Q&A, and I will give you the floor. Once again, you can tweet about this talk using our event hashtag IEU Talks. Now, as you can see on the screen, this is the program for today's talk. After my introduction, we will go straight to the presentation by Sean, and then we will move straight to the intervention by Joe. And then after Joe's intervention, we'll move to the Q&A session where you will be able to get your questions answered. Now, please do send us your questions in the Zoom chat box at any time or raise your hand during the Q&A. Now, today's speaker, as I mentioned, is Sean, who is the, next slide, please, who is the CEO of the Climate Bonds Initiative, which is an international NGO working to mobilize global capital for climate action. CBI is really an authority on green bonds and has been a major contributor in setting global standards for the green bond industry. Their work includes definitions, certification of bonds, working with central banks on how to grow green bonds, market development programs on no less than 6 continents, supporting the European Commission's recent taxonomy of sustainable finance, as well as the International Platform on Sustainable Finance. Sean is also a professor in practice at SOAS University of London. Sean will be speaking about recent developments in the sustainable bond market and discuss the potential that the market holds. Now, many of you may recognize Jo because she served as the head of the IEU until last year when she moved on to her current role as the director of the Environment, Climate, Gender, Youth, Nutrition, and Social Inclusion Division at IFAD. Jo has worked previously here at the IEU, but also at 3IE, UNEP, the World Bank, and UNDP. She's also an adjunct associate professor at Columbia University. While Jo was with the IEU, she co-authored a book chapter in the Global Handbook on Impact Investing, which focuses on impact washing and climate impact bonds. We very much look forward to hearing your intervention, Jo. But now, without further ado, I now have the distinct pleasure of inviting our speaker, Sean, to take the floor. Are you with us, Sean?
I am, I'm here. So, hi, and a special hi to Jo, because we haven't had a chance to dialogue, so to speak, before, and I'm looking forward to your comments, Jo. I'm going to do a bit of a cook's tour of climate bonds, to use an English expression, and I guess there'll be questions arising out of that, but let me just tell you what's actually happening. If I could have the next slide, please. we've seen a very rapid growth of demand and issuance for what is still a niche market. The global bond market is $100 trillion outstanding. But in this particular market, which I'm going to call the green bonds and its daughters, which are other kinds of thematic bonds that use the same model, we're at about $1.7 trillion outstanding. We're expecting issuance in this total sector to reach $1 trillion new this year, at least according to Standards & Poor's. So this is extraordinary growth of the market. Last year, in the midst of what has been in most economies of the world a brutal pandemic, we saw the growth of different classes of bonds, notably for a brief period of about 5 months, pandemic bonds in China, in Austria, and Indonesia, which again, thematic bonds, full faith and credit, where the proceeds were allocated to something that was deemed to be of importance to addressing the pandemic, including in a couple of cases, vaccine production in China. That's disappeared and been replaced largely by social bonds going forward. And the European Union is now the biggest issuer. They've issued, I think, some $33 billion or euros of social bonds allocated towards employment protection measures that have been pursued in the European Commission. But the green bond market is bouncing back. So this year we've seen, in the first quarter, an 81% growth in the global green bond market compared to the first quarter last year. In China, it's 109% growth. We're expecting the Chinese market to double this year, to give you a sense of how this is growing. So this is the headline. This is why we're talking today. A whole lot of things have come off the growth of this market. Well, first, for investors, this has given an opportunity to have bonds at all ratings, AAA down to junk, which address in some form or another climate targets and something they can do. Now, you know, our objective at the Climate Bond Initiative, and we're an organization devoted to mobilizing global capital for climate action, is not to create a private market. That's a means to an end. It isn't the end. The end is to get governments to act. We need strong state action. If we're going to get emissions down 50% on average globally by 2030, which is the minimum target we have to achieve to try and have some kind of sustainable future for our children, then it's going to require very strong state action. We've seen strong state action already in solar and wind. The reason those renewable energies are so cheap around the world is because of the strong state action by Germany and then China with massive procurement programs which drove down the unit cost. It's volume procurement that drives down the unit cost in new technologies, not R&D. R&D gets sucked into it once volume procurement programs get underway. And we're now seeing this in electric vehicles, and we will see it in other areas going forward. So that's what we want to engender here. But the green bond market has been a fantastic icebreaker tool to get investors rethinking their portfolios. There is one thing we have done in the last 10 years here. We have shifted the terms of debate from an idea that green investments, climate-related investments are negative, are going to be a burden, are more expensive, are riskier, to the inverse. Now, when I talk to investors, they treat the pool of investments represented in the green market as lower risk because of the extent to which this has matured and is seen now as an area that is less likely to be impacted by policy transitions. We'll come to a bit more detail now. The crude understanding of why this is happening. For investors, they like something which addresses risk mitigation around climate. It's a narrative that they can take to their asset owners. This is a market globally, outside of China, that's been driven by asset owners being concerned about long-term matching of assets and liabilities. If you saw the Institute of Actuaries report co-authored by Johan Rockström about 4 or 5 years ago, you would have seen the headline which said that by 2050, the portfolios of institutional investors will be decimated by climate change on current trajectories. Note that current trajectories means the worst possible trajectory of the Intergovernmental Panel on Climate Change. So that's the background context. What do we do? What do we do? Especially as modern portfolio management theory typically has only a 5-year horizon. Well, a green bond is one of those things. It operates like any other bond. It has a similar risk yield profile, but it also, as a bonus feature, addresses a long-term risk. At least it is seen to be doing such. And it is something that investors are really keen on, because in the secondary market, the extra bonus feature of a green bond, a bit like getting a free set of steak knives when you buy a car, the extra bonus feature is making it into a premium product. Whenever there's a downturn in bond markets, green bonds hold their value. You might recollect that Larry Fink once said he made money at BlackRock, not by giving investors yield, but making sure they never lost their money. It's a defensive market. So a bond which has superior performance characteristics in the secondary market is gold dust for investors. And then last March, when bond markets froze up around the world, we had investors telling us that green bonds stayed liquid. They were continued to be able to be traded while vanilla bonds couldn't. Now, this is extraordinary for investors. As a result, the secondary market price for green bonds is a premium compared to ordinary bonds wherever price discovery is available, liquid currencies. And as a result, primary price is depressed. In other words, if you're a green bond issuer in US dollars or euros, you are likely to get a lower rate if you issue compared to a vanilla. And in fact, we saw the German government with their green bond prove this decisively, because they allowed a vanilla and a green version to be issued the same day, and in an environment where they are getting negative interest rates. That is, we are paying the Germans to look after our money. Crazy. They got a 1 basis points lower spread for the green format than compared to the vanilla format. This is an extraordinary development. But of course, that's been replicated across ratings levels. So at junk yields, we've seen 30 basis points different. It falls off a cliff after that point. There's a limit to what credit committees will accept, but there's clear preferences for large-scale issuers. And this is leading more issuers into the market. The UK government being the latest with a 15 billion sterling program of green bonds, and the European Commission that is doing a 225 billion euro program of green bond issuance that begins a little later this year. For issuers, whilst they're getting pricing, they are not doing it, they tell us, for the pricing reasons. They are doing it for the closer relationship, the deeper relationship with their investor base, which spills over to equities. So in Europe, a corporate that issues a green bond gets a stock price bounce, and the stock price bounce stays up there, according to 2 academic studies that we've seen so far. The decisions to issue a green bond as a result tend to be a CEO or a board decision rather than a treasurer decision, reflecting of that kind of benefit. So that's the background to the market. But let me move on to the next slide, if I may. There are many different flavors of bonds I've mentioned: sustainable, transition, resilience, blue. The main point is to understand that these are all now focused on achieving the Paris Agreement. These are flavors of gelato. They are not different kinds of gelato. It's not a different kind of dessert, I should say. Now, that's important to understand because it looks confusing at first. Now, this is a bit of work we have to do. We have to continually manage the growth of the market. Bankers, you all know, some of you are former bankers, have quarterly targets, are always trying to get the next deal into the books to meet those targets. That means the envelope gets stretched all the time, to use an English expression. Now, that means boundaries get pushed. We have to make sure that boundaries are set. So we've seen, for example, in the transition bond market, what we at Climate Bonds would call some very weak claims to environmental benefit. Bonds that are invested in gas plants and the like, where the discussion about the necessary ambition is not, well, it doesn't even address the Paris Climate Change Agreement. It's just like, oh, we saved some carbon. Fantastic. Those kinds of boundary issues need to be addressed and are being addressed through the development of taxonomies or green project definitions in China and in Europe and now in 20 other countries around the world. But that's important to address it. The International Energy Agency's report of last week is a critically important report because it lays out what we have to do, at least in energy systems, to achieve the Paris Climate Change Agreement. And Well, no shock to us because we saw this report in 2018 before it was vetoed by the US under the Trump administration. But it says in developed countries, there can be no gas plants after 2035. Coal and gas have to be phased out. The implications of the IEA report, in the words of Fatih Birol, the executive director of the IEA, is there can be no new fossil fuel investments to meet our Paris commitments. Whoa. Now that, for most countries that still have gas as a central part of the transition plans, is mildly terrifying, as it should be, because we have been sold a pup with some of these measures to achieve transition over the last 20 years. I'm going to draw particular attention to the gas industry that has continued to push a relative improvement plant by plant between coal and gas of about a third the emissions as being the argument why gas has to be part of the solution. It utterly ignoring the fugitive emissions from the gas supply line that, if you start accounting them, can lead to an LNG gas plant in Australia having the same greenhouse gas footprint as a coal plant. And we now know, thanks to NOAA and NASA studies of the last 10 years, that the methane leakage into the atmosphere from the gas system, took us a few years to figure out it is the gas system, has been massive. And now you'll get, just in the last year, satellite maps of methane leakage around the world by many parties, which will show plumes everywhere. Turkmenistan, Russia, the Permian Basin in Texas, Indonesia. It's like crazy. If we factor in this gas, which is 84 times as potent as CO2, then we find that our savings from having shifted to gas are way overstated, and our savings from shifting to gas have to be predicated on measuring, capturing and measuring fugitive emissions across the supply chain, which they're not, except in Equinor and Norway's case. No one else is doing this. So this is an example of the science discussion we have to set boundaries. We have to look at this and properly understand the nature of the emissions profiles we need to achieve, but also looking at resilience investments. You know, we've got volatile climate change. It is the norm. It's only now a question of how catastrophic that volatility will be this century. And we've got to prepare our societies. Resilience investments in developing countries will become the norm in the next few years. And we will be bringing that in, expanding the green bond market universe to include them. We've already seen a number of resilient investments, whether it's water investments in Cape Town, who issued a green bond, or the Netherlands government, who issued a sovereign bonds to finance coastal protection. There'll be a lot more of this going forward. Next slide, please. So the key point is, this is a global phenomenon. About a third of green bond issuance is emerging markets, dominated by China. In reflection of the size of capital markets, I want to hasten to add. But we have seen issuance, and we have vibrant programs in India, in Brazil, and many other places. So in Chile, for example, where the government has now issued sovereign green bonds in pesos, US dollars, and euros, they've achieved the lowest interest rates they've ever achieved for sovereign issuance, the green bond program. In Russia, where Russian Railways has issued 2 certified climate bonds in the European markets in francs and euros, they got the lowest rates ever achieved by a Russian government entity as a result. So as you can see, it's happening everywhere, and it's pretty exciting. Renewable energy companies in India are issuing green bonds into the European market in US dollars and the like, where they are getting price benefits compared to vanilla of something like 30 basis points. And so we're going to see many more of these from Azure, from Greenco, from Renew, from Adani Green Energy, and the like. This is a global phenomenon commensurate with the relative size of bond markets. I mean, the US is way, way, way the world's largest bond market. China is now the second largest, Japan the third. So the Chinese market, which is the second largest green bond market in the world, reflects that. About 2% of bonds in China are currently green. My friend Marjun at Tsinghua University says the target in China is about 20%. We've got a long way to go. And that should be a global target in my view as well. But we're well and truly on the way now. Next slide, please. So the issuance process is pretty straightforward. People need to decide they've still got to have a means of achieving creditworthiness. This is not a replacement for addressing the fundamentals, the financial viability of issuance, which is scale, creditworthiness, currency for that matter, in different places. We are, of course, working on greater appetite for emerging market currency. And one thing I can tell you this year and last year, we now have strong appetite by a number of Western investors for domestic currency, government level bond issuance in key emerging markets. This is a change. So the Indonesian government can issue rupiah green bonds now in a way that wouldn't have been able to 3 years ago or 4 years ago when it started its program. And that applies to all the major economies going forward. In other words, investors are able to deal with the hedging risk if they've got the security of government level creditworthiness. They're generally zero rating government level credit, apart from a few countries like Mozambique. And there's a story there to tell about malfeasance in Mozambique. So the creditworthiness issue and the currency issue are rapidly evolving. Now, if we can get development banks to do more support of domestic market programs, then we should be able to get international investor participation in, say, rupiah bonds from the commercial market in Indonesia, because the ADB can take up some of that credit, or maybe using a slice of funding from the GCF, as we have seen in some funds that have applied successfully to the GCF for funding and are coming to fruition now. So there's a job about blended finance to address these issues going forward. But at the end of the day, you've got to have some kind of level of creditworthiness that the market wants, and demand is at the top end of the market, not the bottom end of the market. You've got to have scale. $20 million bonds don't cut at international markets, but they might in a domestic market. And currency, you've got to be able to address whatever the currency issues that you're facing. Then you've got to find qualified assets. We now have the guidance of taxonomies, the climate bonds taxonomy, which has been around for 8 years now, but we have the regulated green projects definitions of the Chinese taxonomy, the European taxonomy, which is a regulated instrument modeled on the climate bonds taxonomy. And we are working under the rubric of the International Platform on Sustainable Finance, an EU created vehicle, on a common ground taxonomy between China and Europe. We'll publish a first report in September. The Hong Kong Monetary Authority has already said it will follow that common ground taxonomy. So expect more developments here. And then finally, they have to track and report and get an independent review. The independent review will assess their tracking and reporting systems, as well as assess the green credentials of the underlying investments. It's pretty simple. There are costs involved. The benefits are the investor engagement, increased investors, access to investors, a critical issue for emerging market corporations. And then sometimes, depending on the currency you're using in, there can be a bit of price benefit approaching. Next slide, please. This is an example of a climate bonds taxonomy. This is a constantly evolving beast of different kinds of areas. My main point here is say it's not just renewable energy. It's low carbon transport, it's water, it's buildings, it's land use issues, it's waste, it's ICT, etc. Really, this guide to what is green is being expanded as we go, and it will cover the bulk of the economy over time. It is dynamic. There is scope for changes of targets necessarily, especially as our targets get tougher. Like right now, we're wrestling globally with what those 2030 targets are, which is why I mentioned that gas conversation earlier. And that is changing national climate change plans that is being reflected in taxonomies. Next slide, please. This is a reference slide for you of the market. The main thing is it's growing very fast, but it started in development banks. The European Investment Bank and then the World Bank issued green bonds in 2008. It took to 2013 before we saw commercial green bonds. And since then, we have just taken off. We see market issuance by every kind of actor that can issue a bond. There are examples of them issuing green bonds. The largest bond issuer, green bond issuer in the world is actually Fannie Mae, the secondary mortgage company of the US, who issues green bonds to finance energy efficiency and water efficiency improvements in multifamily homes, social housing of various sorts. Next slide, please. I'll pick up some of the questions in a minute. Of course, underpinning all of this is a deep understanding of risk. We have physical risk, the impacts of climate change. And this is a slide, by the way, by a friend of mine at the Bank of International Settlements, currently working on the Basel II review. I want you to understand that regulators absolutely understand these risks now. This is a change in the last 3 years. So the Bank of International Settlements, this is the Financial Stability Institute, is looking at what the kinds of risks the financial system has going forward and how to address those. Clearly physical risk, that's the sea level rise and all these other kinds of physical risks we're aware of and how that might affect the ability to operate. Mortgages are a particular problem for insurance companies going forward, but transition risk. This year, in the context of the substantive commitments to 2030 targets by many countries around the world, not that they know how to do it, but they're committing, we have a heightened transition risk. Everyone believes in my world now that change is happening. The shape of the future is decided. It will be clean and green. It's now an argument about the speed of transition, how quickly we're going to get there. Of course, that is very material. If we don't change quickly, we miss the window to try and manage the world's climate in a reasonably sustainable fashion. We run into runaway climate change and feedback loops. So speed is everything now, but at least a decision about whether it's going to happen is well and truly past us. Let's call that a curious dividend of the brutal pandemic we've just been through. Next slide, please. So the developments, the network for the greening of the financial system is a critical development. Now 90 central banks around the world, originally led by the People's Bank of China, the Bank of England, the Banque de France, the Dutch Central Bank. The Fed applied to join in the US 3 days after the election was called. As you can see, there was pent-up demand there. We've seen regulated definitions, taxonomies becoming the norm. There are 20 countries around the world. South African Ministry of Finance got their taxonomy to review last week. And this same kind of thing is happening in Singapore, in Chile, in Russia, and Kazakhstan. The major economies' net zero commitments of exemplified at the Biden Climate Summit are incredibly important. They confirm that the developed world and some of the developing world have now committed to dramatic change. When we've spoken recently of Janet Yellen's office, the US Treasury's office, it's clear that they are very fixated not on the 2050 target, but on the 2030 target, as they should be. But I have to say, it was a breath of fresh air to hear them talking about the incredible challenge of meeting the 2030 target of 50% cuts to the US economy since 2012. This kind of policy change post-pandemic is and post-US election, let's face it, is critically important for us to understand the changes that are coming. And as you know, Japan, the UK, Canada, Korea, and many other countries have made similar commitments. We need to appreciate the extent to which we have already taken action in terms of strong state action. I've mentioned solar and wind. We are seeing this play out in electric vehicles now, thanks to aggressive push by the Chinese authorities to shift the car fleet to electric. The capex cost of cars is dropping like a stone, electric cars. We expect over the next 18 months that electric cars to become cheaper from a capex version compared to petrol cars. They're already cheaper from an OPEX, an operating cost version. In fact, last year, in 2020, in Germany, when it comes to fleet cars, and most cars of the future will be fleets because people are shifting to shared card schemes, whether that be Zipcar in the US or Didi in China. Fleet cars in Germany, 50% were electric last year. 50% of the cars sold to fleets were electric last year. Critical turning point. We're going to see this happen unbelievably quickly in the future. It's the main constraint is the production capacity of car companies to produce electric. And of course, as they ramp up, the unit cost drops like a stone. So you can see how strong state action in China is leading to a dramatic wave of changes around the world, which will impact the valuations of oil companies who are dependent on auto demand for oil, and the valuations of car parts companies in Mexico, where I've been speaking to the pension fund industry about the need to rapidly shift those companies' strategic thinking to try and make money out of electric, because otherwise they're all going to be toast. They're going to lose money as Ford, General Motors and others shift to being electric. And you've seen the announcements, but it's going to happen even faster. This same thing is going to happen in hydrogen. We expect green hydrogen to be cheaper than natural gas within 10 years, possibly sooner. That's because the cost of solar continues to drop like a stone. Saudi Arabia had an auction a few weeks ago, 23% cheaper than the same auction a year ago. This is continuing to happen, and there'll be no let up over the next 5 years. The cost curve will drop. It's going to make things unimaginable a mere 5 years ago being the norm in the next 5 years across emerging markets. Coal in India, 60% of plants are currently running at a loss. Why? Because their premium industrial customers have been stolen by solar generation power purchase agreements, which are delivering cheaper and more reliable energy to those industrial customers. We will start seeing announcements this year of phased close down of coal-fired power plants, replacing them with solar across India. We can see the end of coal in India now, despite the government having an official policy of supporting coal going forward. So the changes are happening very fast. When hydrogen is cheaper than gas, do you think anyone's going to buy gas if they can afford to shift to hydrogen, or if they can use the capex to use it? Of course, we will see a drastic shift in steel industries, in various kinds of transport industries, and that will ruin the investment profiles of natural gas. This will happen in 10 years, not in 20 and 30 years, in our view. Well, at least there's a very high risk of it happening, which means there should be a risk premium on these investments. And that's the conversation I'm now having of oil and gas banking teams around the world. And they're accepting this, which is rapidly changing the profile, the investment profile for these companies. Next slide, please. In the EU taxonomy, just to give you a bit of flavor, we've seen the growth of a science-based dynamic taxonomy introducing new elements. Do no significant harm is like you can't build a solar farm on a wetland. Sounds obvious, but it needs to be spelled out. Next slide, please. And there are minimum social safeguards. The taxonomy development is going around the world. These are countries that I'm aware of at the moment that are developing taxonomies. Next slide, please. So finally, there will be a lot more work coming to market this year to make it easier to know what to do, with implications for incentives across the different size parts of the economy. We will see more incentives, more blended finance to crowd in private capital across the economy. We will also see new instruments development. We saw 2 days ago, Goldman Sachs announce green equity. What in the world is that? Well, I know a number of companies that are doing green equity modeled on green bonds going forward, but it'll be a lot more than that. It'll be aggregation vehicles for municipal investments in India, which will use green bonds to be financed. It'll be catalyst funds set up by the Asian Development Bank, as they have already done in many countries. A lot of these things are supported by the Green Climate Fund, or will be supported by the Green Climate Fund going forward. But most importantly, this year, we expect the discourse on a green window carve-out in the midst of trade wars between China, Europe, and the US. While they will fight like cats and dogs, because it's electorally popular, we will see cooperation. We are seeing already cooperation on green, collaboration on meeting our targets. Think of this as ending up being zero tariffs for zero carbon steel. So while Europe will bring in carbon tariffs next year, exclusions for products that are reflected in the taxonomies, the common ground taxonomy between China and Europe, will become the norm. And that'll also apply to financial products. We expect to see selective loosening up of capital controls in many countries if it's green, as part of the quid pro quo here. Green window will become the norm. I'll stop there. Over to Joe, and we might pick up questions in a minute, if that's it, unless you want to do it differently.
Thank you very much for your presentation, Sean. We already have received a number of questions in the chat box, and for the first time in the IEU Virtual Talk history, we have received a large number of questions pre-submitted via email. So I think we will have a very busy Q&A session. But before that, please let me turn to Joe, our discussant.
Thank you, Iben, and Sean, very good to meet you too. I'm hoping that we'll get a chance to chat, hopefully post-webinar as well at some point. But with that, let me share. So I have 2 or 3 slides, I think. Let me just share my slides and get on with it. So Sean and everyone else, the lens that I'm taking is one, I think needs to be defined before I go in. And the first one is recognizing the huge responsibility that we have as citizens of the world, and the responsibility and the big weight of change that we are placing on these instruments. So that's one. And second, that of developing countries especially. GCF and a lot of the institutions, and my current institution, the International Fund for Agricultural Development, we focus a lot on developing countries, primarily on developing countries. And it's really important to understand as to what are the institutional frameworks, but also the incentives that are present that can help us see the change that we want to see with some of these instruments. And so my short set of comments is actually titled somewhat provocatively, dealing with climate washing. But before I go forward, Sean, I do want to recognize that your institute's done really interesting work and really good work in this space. And I'm hoping very much that we can push this dialogue quite forward, actually, especially in ensuring that there's far more credibility and far less washing in this space. So that's essentially what I'm going to be focusing on, right? Okay, with that, I think over the weekend, there were 2 things that I did, as we all normally do. I read the EU gas reporter tracking report, right? So this is basically what the EU is spending on a lot of things related to energy. And one of the key things that struck me as quite interesting was that they're going to be spending and investing approximately $2 trillion on just gas-related pipelines, something that Sean mentioned in the passing, but it really also intrigued me to understand that on one side, there are countries in the EU that are committing to really ambitious targets for 2030 and also for 2050. But on the other side, you're investing close to $2 trillion in long pipelines that are all fossil fuel gases. So essentially, this means that whatever we might do in terms of individual behavior on the ground, in terms of stranded assets, we're essentially determining what our development pathway is going to be for the next 30 or 40 years, and that's still not counting the overall greenhouse gas effects of a lot of these gases, right? So because these are stranded assets and we are just investing in them. So so that's one of the reports. And the other one that I also looked at was the EU taxonomy report that Sean referred to as well, and the climate delegated activities that are presented in there. But I'll comment on that a little bit later. The problem of impact washing really comes from recognizing that in the ESG sector, and one of the questions really in the chat box was asking, well, what is the size of this sector? Currently, just ESG, yeah, it has moved in the past 5 years from $23 trillion to $40 trillion in terms of ESG investments. That means the responsibility in this sector and what we are thinking will drive impact with respect to ESG is huge. But that's one side of the picture. I think the part that I'm really concerned about as a global citizen, but also as a member of an international organization, is, are we really seeing impact on the ground of the kind that we are anticipating and visualizing as a consequence of these instruments? We've argued, and my co-authors and I've argued and have shown as well, that with a lot of the instruments that we are using, there is a lack of rigor in the measurement of impact, which is driven from, one, seeing confounding impact for essentially a lot of what we would call in a theory of change just outputs. If you look at the EU taxonomy as well, a lot of the EU taxonomy, whether it's related to climate mitigation, related to climate adaptation, related to pollution, etc., as well as a lot of the sectors that Sean spoke about, especially in agriculture, especially in, well, definitely in agriculture, but also in land use, really relate to very near-term outputs or activities that firms may be undertaking, but that are often confounded with long-term impacts that we want to see in this area, which are just not accounted for either in taxonomies or in the kind of ask that we are making of this sector. There's a lot more focus on performance contracts or output contracts rather than on development outcomes and impact, which is essentially the genesis of why we went into this space. There's also a lack of uniform and evidence-based methods for impact measurement. What happens as a consequence of these investments that are coming from green bonds, that are coming from resilience bonds? Are we really seeing resilience on the ground? I mean, I can tell you there's no internationally accepted definition of what is resilience. Yes, you can locally contextualize it, but to really then say that we are bringing about a change in resilience as a consequence, say, of a resilience bond requires far more thinking than has gone into this space. And it's not to say that we don't have globally, that there is no expertise in this space. There is definitely expertise, but there's a missing market. There are potential suppliers, there are potential demanders, but there's a missing market in between that I think we need to try and address very quickly. I want to move to impact measurement, and as I'm speaking about this, but I think overall impact measurement standards in the industry, with some exceptions, basically borrow metrics from different frameworks, but they're not consistent with each other. And they also face a lot of difficulties on the ground. And of course, a lot of the premia that are asked for by a lot of the firms that really operate in this space are related to understanding and delivering on the impacts that are being promised. Okay, my second last slide is really focusing on, well, what is one of the solutions that we can think of, and where could there be a role for independent international agencies such as, say, GCF, but also, of course, of IFAD, where we could come in and play important roles as mediators, but also as credibility drivers in this space. And it really, focuses on, and you'll notice that I have put in very critically, rural smallholder farmers. Rural smallholder farmers are a very important target group for IFAD. But
well, so we've put this extra slide on what we've done so far.
Excuse me? Okay, sorry, could you mute yourself, please? I think the important part is to recognize that the role of verifiers and the role of the enabling environment right now is more critical than ever, because the world is path dependent. And if we don't correct it now and don't change both taxonomies as well as develop protocols, this is going to lead to a very different future than what we had anticipated with the emergence of climate bonds, as well as ESG bonds generally. So my last slide, what happens? And it's again provocatively titled, Who Guards the Guardians? On one side, we're developing these instruments and we're clearly looking at them with a huge amount of, towards them for a huge amount of delivery on promises. So there is, I think first we need to recognize that there is a responsibility, but a responsibility also in terms of integrity and credibility. And we definitely need to innovate. So resilience bonds, etc., are there, and a lot of the bonds that Sean spoke about. But things like equity, things like leakage, we don't address them in any of the taxonomies that we are currently looking at because they tend to be extremely siloed. But this is exactly where a lot of the adverse consequences of our investments are going to come from. In global public goods, we have recognized this now for the past 100 years, that it's the impacts that are occurring outside of the system that we really have to target as a consequence of our interventions and not just be looking at it in a siloed way. One key thing that I do want to push forward is that do no harm, which is really the underlying basis of, the taxonomies that I've seen emerge till now, is just not enough. We've got to push that and to see that it is much more than do no harm, that it's positive. And here, dealing with leakages that are both geographic, spatial, as well as thematic are really important. Here and in this space, I think it's really important then as international institutions for us to think about creating incentives for true impact and for also catering for the premium that we clearly have to pay at this point. So I do think that this is not still a fully developed market. Sean said this as well. And of course, where I'm sitting in IFAD, we constantly are thinking about how to have a very, very deep pipeline of these projects and investments that can really deliver the kind of impacts that we want to see on the ground. And that is one of the challenges. But as we do that, I think we've got to co-develop the institutions that go along with it. And that's a key responsibility. And very much like what we saw during the Great Depression, I don't think any one of us was alive, but it's really important.
That's a crazy thing to say, Joe. Crazy thing to say.
I know.
I'm going to quote you on that.
Please do. Because before the Great Depression occurred, actually there were no standardized, there were no standards in terms of reporting on financial health of companies, no standards that were globally recognized. And chartered accountants as an entire discipline were essentially decried because it represented a cost for the industry to bring on chartered accountants that had globally recognized standards, right? Guess what? The Great Depression made us remember and think about what is a good way to convey financial health. And suddenly we had this cadre of accountants that could tell us in a very standardized way as to what the financial health of a company is across the globe in an internationally recognized way. We've got to do that now. Otherwise, it's going to be too late. Thank you.
Thank you very much, Joe, for your intervention from this, I guess, an evaluator's perspective. It's very interesting to hear. Now we've received a large number of questions in the chat box. I want to go straight to a topic that both of you mentioned, which is resilience bonds. This is also a question that we were asked in the pre-submitted questions before the event. Clara Gallagher from IIED asks, on resilience bonds, how do you see the strengths and weaknesses in their use as a tool to finance loss and damage in climate vulnerable countries, both in a technical and a political sense? Joe, just for you to catch your breath, I might ask Sean to come in on this first.
Green bonds don't solve everything. They're trying to address one thing. So if you've got an issue you're pursuing, like loss and damage, it's not going to be solved by green bonds. You've got your existing channels to try and achieve change. What green bonds are doing are mobilizing investments that still have to meet the standard risk yield requirements. I mean, you've still got to pay a return. If you're not paying a return, it's not for this. Good luck in the agenda you're pursuing now, which is an important agenda, but it's not here. However, let's look at what's got to be done in the next 30 years. First, we have extraordinary mitigation challenges. That will be largely the major economies. That'll be China, Europe, and the US, and other major economies like Japan. And then India as it grows. We have to invest in clean and green. That can all be done with investable propositions with state mediation to reduce risk, to take away risk. For example, banning some things makes other things less risky, as we've done with incandescent light bulbs in Europe, by making LED light bulbs more attractive, by just banning incandescent light bulbs. There's a bunch of stuff we can do, but it's private money mobilized with the support of public sector institutions together that can fund all of this. And between now and 2030, we have to invest some 2050, I should say, some $90 trillion US in clean green infrastructure, with 70% of that in emerging markets, making cities like Lagos livable, for example. So that's the job to be done. And we can use private capital for the bulk of that, including infrastructure. You know, let's take transport. We have used in the West hasn't really solved this very well, to finance subways with public money. But Hong Kong's MTR shows us we don't need to do this. We can have still a public sector body, but using private capital to build the subway using property value capture by building shopping centres above stations and paying a dividend back to the government. That model, which utilises private capital through a public sector owned 25% listed vehicle, can work in Lagos, in Jakarta and Sao Paulo. So in each different area, we've got to look at models which can mobilise private capital to be able to do what needs to be done, because we have got a shortage of public capital. The public capital we have has to be used to leverage. It used to be made super efficient going forward. The resilience agenda, the second strand, is more complicated. For emerging markets, yes, as someone said, will there be risk to credit rating? There is. Moody's is already bringing in credit rating points which will make it harder for an emerging market country in the path of climate change to raise money. In other words, the cost of capital is increasing. It's a problem. As I've said in my discussions of Moody's and of S&P, this is not exactly a solution here. But of course, where the solution can work is as we start understanding what governments can do to mitigate that risk, to improve their resilience, those countries that are taking action will get preferential credit rating. And that we have an open channel with the credit rating agencies on this. I mean, you know, for better or for worse, we've got them. They're not going to go away, even though some of us wish they had after 2008. They're still there, part of the architecture. So we have to work with them. The question is, will governments do it? So as governments start adopting resilience plans, this will have an impact on their sovereign borrowing costs going forward. And now we've got it, as Joe says, that the knowledge is actually there. We kind of know what to do. We're not applying it. Now, I'm not talking just about physical infrastructure, although in Lagos, for example, the nature of protection around the lagoon is critical to whether Lagos is still going to be there in 30 years' time. So there are physical infrastructure challenges in many places, but there's also social and economic resilience. And if there's one thing we've learned from the pandemic, which is after all rooted in the collapse of biodiversity, pathogens jumping between species as a result of distressed bat colonies. Hey, guys, this has been predicted by the IPCC Health Committee for 30 years. It's no surprise to us. They say when we have climate volatility, we will see more pandemics. Get used to it. And we've learned from the last pandemic that there are stuff we've got to do to better survive a pandemic. Free health for everyone is a critical climate resilience investment now. It's no longer a nice value added for social objectives, because when people can get healthcare when they get sick, that means that they will get it and don't have to pay for it. They will get help rather than keep working, as we saw in the US, where janitors and cleaners kept working despite having the disease, and they died in higher numbers as well. And that has a consequent impact because the pandemic keeps spreading and everyone suffers. And we've seen this with a lack of healthcare in India now. Now, of course, in some countries, it's challenging because we don't have the resources to create it, but we have to globally. We now have a global imperative to create free health and emergencies around the world, specifically to stop collapse of world economies in the face of pandemics. And note, this pandemic only had a 1% mortality rate. Were we lucky? Are we lucky? Because the SARS one had a 10% mortality rate, and it was mainly people the age of Andrea Thurman who died. It wasn't people who are old like me, because of the different kind of effect it had. So we've got to understand the risks we're going into and take action. And as we can take action against a toolkit that has to be recognized internationally, we will get benefits in our ability to raise money. Sometimes it'll be specific investments. We've already seen vaccine bonds, for example. Sometimes it'll be the impact on sovereign issuance. I want to address agri here, because in agri, there is a mitigation agenda. Clearly, sequestration is a great hope for the agri sector. We need to be able to suck carbon out source. That means changing the nature of our agricultural practices and what we consume and eat, and reforestation on a massive scale. But resilience is also a critical issue here. We do not have enough understanding for financial markets, for corporates, of what's in and what's out. As I talked about the gas, it's a developing understanding. In Europe, on one side, we're investing in gas, and the other side, we're saying no more gas. That fight is happening in every country in the world on mitigation. It has to happen on adaptation and on agri. And we're just starting, Joe, our work on transitions in the agri and the food chain industry. And we would love to have a deeper conversation with you at IFAD about that and involving you, as we've already got CGIAR involved and so on. We have an MOU with the Brazilian Ministry of Agriculture, the central bank, to do work in this area and promote it. We've got opportunity here, but the work has to be done and be promoted. This is a lot of work to happen, but we've got to bring it all together, and we've got to stop the silos that have been happening in the last few years, which aren't talking to each other. Financial markets, where I primarily work, need common approaches. They need industry-wide commoditization to be able to grow. And that requires bringing everyone together and coming up with rule sets that can be used. And, you know, this year we can do it. We are making progress. In Europe, we have adaptation in the taxonomy. We have resilience to taxonomy. We have a tough discussion on agriculture, as well as all the classic mitigation areas. It's got to go global.
Joe, let me throw this over to you at this point. Would you like to comment on this issue of agriculture resilience?
Well, yeah, and perhaps also to the first question that you raised, but using a slightly different angle, which is, so just to go back in time, I was in Namibia about 2.5 years ago while I was still at the GCF. And Namibia at that time was facing a huge drought, and it had been facing it for the past 3 years, right? I remember talking to a lot of the government officials then and saying, well, you know, you could at least start to think about how you can get insurance to guard against this, or to at least be able to get social protection for citizens. The thing is, no agency around the world was ready to provide that insurance. Namibia as a whole was uninsurable. Why am I saying this? Because the idea of resilience bonds and other such instruments actually do give us one way in which we can bring in the private sector, create the incentives, and still build these protection systems, which are really important. Now let's shift focus to the Caribbean. Really, I think the point is, how do we construct contractual mechanisms so that there is incentive for both the private sector players as well as governments, as well as for, you know, the households, essentially, who are going to be the end beneficiaries here. Let's remember that in all of our conversations, to be involved in mechanisms such as this. Recognizing what insurance companies do already, that countries, each single country is not going to be insurable, because when typhoons occur, for example, in the Caribbean, you have a correlated regional risk so you're not going to be able to hedge your risk. But what you can do is use resilience bonds to really provide a price signal, as well as an investment signal that, look, if you invest in adaptation and adapted infrastructure, and I'm using it in the sense of climate adaptation literature, then when a Category 5 typhoon occurs, this is a trigger, if your airport does not collapse, for you to get a payout, right? Then it acts as an incentive on one side, and that's the bond that you're raising, but it acts as a trigger on the ground to really get the kind of transitions that we want to see in our development pathways as well. Thanks, and back to you, Iben.
Thank you. I would like to move to a different topic now, which is the issue of taxonomies. We received a question, which is, investors have repeatedly called for the development of a common taxonomy for green bond issuance. Do you think, Sean, such a harmonized taxonomy is possible, given the specificities of each market? We also really received a question in the chat box on, is it even a good idea to have a unified taxonomy?
Yes, and yes. I mean, of course it's possible. We can decide what are the right things to do, and we can decide what are the wrong things to do. We may not get it perfect, but at least we'll get things changing. And frankly, we spent 30 years prevaricating, saying, oh, those climate scientists, oh, that's right, this is really bad, isn't it? We're going to die. Oh, what about we just do this? That'll do, won't it? And now we're in this mess where our climate policies have utterly failed us for the last 30 years, and the emissions reductions pathway to even have a reasonable chance of a future. I mean, it's not a great future. We're going to have climate volatility come what may this century. We're talking about reducing catastrophic climate volatility because we have mucked around for 30 years. For God's sake, we can do some crude measures. We are doing crude measures to get things moving. Some things are not in. We need to understand that, and we don't yet understand it. The conversation Joe and I have about gas, for example, this is a developing understanding. But cars, hybrids, Toyota, hybrids are not in anymore. They're not ambitious enough. You've got to shift to electric or hydrogen or whatever. Taxonomy is driving this agenda and is starting to exclude a bunch of things that people have been saying, hang on, I thought it was better. Are you sure about this? Can I just check the figures on this? And that's the conversation that is absolutely necessary for us to have globally, and taxonomies are where it's happening. When we started this work 8 years ago, we deliberately wanted to design the taxonomy, I'm afraid, to bypass NDCs. Because, well, actually before NDCs came in, to bypass national climate change plans. And I'll tell you why. Because NDCs are creatures of the Ministry of Finance permission to do stuff. The ministries of climate change have been saying, we've got to do this. Ministries of Finance have been saying, oh, yeah, but, you know, I don't think we can go that far. And by the way, the gas industry says gas is in, so we should allow that, et cetera, et cetera. And now we've had, as you know, NDCs in aggregate around the world, if they were implemented, as if, would give us 3.5 to 4 degrees warming. I mean, is that a failure or is that a failure? Well, I'm going to say it's great we've been doing NDCs because it's something we can work on, but we've deliberately chosen to bypass the NDC process. So when the World Bank put out its guide to taxonomies, it said, base them on your NDCs. Wrong. Base it on the science. It's like when you look at the IPCC report. What do you want to really read? You want to read the science reports. You don't want to read the final mediated report where the Saudi Arabian delegate has bloody well signed off on it, because it's going to be weak, for God's sake, or weaker than it needs to be. So science base is a critical issue. Of course, when we do government regulated taxonomies in China and Europe, we start getting involved in the political arguments, stuff gets pushed around at the edges, we lose some fights. That's the nature of government democratic process. But starting on science base, we're making much more progress. We ruled out gas in the European taxonomy 2 years ago, a whole year before the Europe adopted the kind of targets that mean gas can't be in. That's how we're using the taxonomy. Now, can we do it on resilience? Can we do it on agriculture? Can we do it in the areas where work's got to be done? Relatively low capex areas, but important for emissions areas. That's the job coming forward. 20 countries around the world are working on taxonomy now. We have managed to engender a global conversation on boundaries, which frankly was not there before. We have synchronization between all of these taxonomy projects. There are arguments about edges, but they're basically using the same approach, and a whole bunch of the technology is copied between each one. The South African Ministry of Finance is reviewing their draft taxonomy now, which looks, smells, walks and talks like the European taxonomy, flavored for South African circumstances. That is good. Why? Because we need international and domestic capital mobilization here. We need to avoid speed bumps between different taxonomies. The reason the PBOC took out supercritical coal and efficient gas from the taxonomy was partly because the Chinese are now wrestling with climate change, and partly because it created a speed bump for international investors participating in the Chinese green economy. In fact, it was dampening investment and still is as we get used to the new taxonomy. We need common approaches. We need a common ground. We need a common framework. Every country will have its own outfit. There'll be a Nigerian outfit. There'll be a batik shirt in Indonesia. But the skeleton, the structure of these taxonomies is the same, much the same around the world. Well, if we're successful in this particular work we're doing, which we're working hard at now, it'll be much the same, and we'll have interoperability. So that's the future. So I wouldn't worry too much about the fragmentation. I think we're doing a reasonably good job of keeping them broadly in line. I don't want to downplay the turf wars, the boundaries. They are there. There's work to be done. It's not simple, but it's nowhere near as bad as it looks at the moment. In fact, it's actually really positive.
Thank you, Sean. We are over time already, but I would like to turn now to the question of impact washing. One of the questions we received before the talk is from Josh. It is third-party certification effective against greenwashing or impact washing? He also asks, isn't it discouraging investors from upscaling the green bond market? Joe, would you like to comment on this?
Yeah, so thanks, Iben, and thanks to Josh. Last question first, is it discouraging investors? I think that's the wrong question to ask. I think this is really about market creation at this point, and this is when you start to set what the norms are and what the rules of the game are. So I think, with due respect to Josh, I think that's the wrong question at this point, but I do think that it is important to think about, well, what are the current solutions in this space? And having looked at this and thought about this for quite a while, and also seen CBI's work in this space, I do think that it is important to think about independence of a lot of the verification procedures and third-party verifiers. But that's not, and let me be very careful when I come in here, I think it's really important to recognize that even in environmental regulations, even in a lot of the social regulations, it's really important to understand as to where the incentives lie. Markets rule whether we like it or not. And so if the incentives are, if you have a so-called independent verifier, but paid for by the company that's putting out the bond, that's not really independent. And so I'm not going to take names, but a large part of where this market started from, and I looked at HSBC, I looked at a whole lot of other companies, and I've been seeing the pronouncements also about disinvestment, say BlackRock, right? A lot of those announcements are really, the announcements when they were first made were predicated on these verifiers that really went outside of the overall paradigm, or outside of, and there still continues to be a large amount of conflict of interest. I think that's something that we need to guard against and be very, very careful about as we go forward. And again, I think independent international organizations can both help to standardize, and this is what Sean was talking about, think about what the edges are, what the boundaries are, but I am keen to see as to how this entire environment can be pushed to also understand that leakages will exist. And so that's why having common frameworks is important, while recognizing country capacities as well. But on the other side, also recognizing that incentives and conflicts of interest really have really pervaded this space for now. And that's something that we need to be really cognizant about as we go forward. So it's not the solution. I think we've got to be very thoughtful when we put these systems into place. Thanks.
Yesterday, we published our proceeds of green bond report, post-issuance reporting report, 40,000 words on our website for free. It's a fabulous report. Have a look at it. Covers this area in detail. The headlines are, there is no greenwashing in the sense of people deliberately misleading the market going forward. People are being honest about what they're doing. It doesn't mean it might not happen in the future, but for the moment, and especially as incentives come in, but for the moment, we have a robust one. Why? Because bond issuers tend to be repeat issuers, and they need to keep their investors happy, and they're terrified of being frozen out. And as one bond issuer in Hong Kong said to me, after he issued his green bond, his investors took him to lunch and they said, you're going to have to do this right, because if you don't, we're going to screw you. You really understand this. You understand this, don't you? And so there's a self-policing mechanism which has served us well so far going forward. The independent review model is critical to making this report. We, of course, at Client Bonds think it needs to be more. We have a certification program, independent standards, 20% of bonds are covered by certification, but only 20%. But I'm going to say greenwashing is not there at the moment. What there is a heterogeneity of reporting practices and a confusion about what's in and what's out. I'm going to say confusion because people are explaining what they're doing. They're being transparent. We can actually make the judgment as investors, as citizens, but we might disagree. So you will see transition bonds that have gas. I'm vocal in the media attacking them, but I don't attack them for lying. I don't attack them for greenwashing. I attack them because they don't understand the science adequately. They're not channeling the science. This is where taxonomies will make a difference if we can get them right. This is where guidance to the market will improve things. So while there's a fear of malfeasance and, you know, credit ratings agencies, we have a system in place. It's working reasonably well. We can improve on it. We need, as Joe says, common formats now for reporting. We need to understand if a resilience reporting in Kenya is the same or can be comparable to resilience reporting in Mexico, for example. Is it comparable? There's ways we can do this, and that will make it much easier to have confidence in the market going forward. And then we're going to have regulatory oversight. In China, we have regulatory oversight. In Europe, as of 1 January, we'll have regulatory oversight. And that's going to happen in all markets by the time we're finished.
Joe, I see you raising your hand.
John, I'm going to quote you in reverse about with your statement on, oh, there's no greenwashing. I think we're not asking enough of ourselves and our systems. And yes, there are reputational effects, and yes, we can depend on the transparency that is incorporated in our current mechanisms. But I think those current mechanisms still remain very, very nascent and rudimentary in what we are asking of them. And that's my key concern about greenwashing, but also impact washing. Yeah, I understand that Iben's ready to close this session, but I think we do have to be somewhat less sanguine and far more critical of what we are delivering.
Look, I have to say, and even I'm just going to keep going for another 30 seconds or so. I have to say that there is a confusion, I'm going to say, between impact and finance. So what people discuss as greenwashing in the green bond market is, hang on, this is an investment in a solar farm that was built 3 years ago. And we're saying it's still a solar farm. It's still green. And bonds especially are a refinancing tool. They are not used for project finance as a rule. For that, you need equity or bank lending. They're a way to refinance. And by making the refinancing of green, the exit strategy for green attractive, you incentivize and empower project finance and equity going forward. We're seeing this, and it's Mark Carney that used to talk about this at the Bank of England. So we have to look at the capital stack. If you want to look at only additional projects, this is not the market for you. This is not the place to go. There's a little bit of additional, but even when people are claiming additional, like the World Bank issuing green bonds to finance additional, actually the creditworthiness of those bonds is existing investments. So it's a kind of sleight of hand, if you like, with intermediary vehicles borrowing against old investments to then grow new portfolios. So it's complicated. So that particular aspect of additionality is a red herring. This is not carbon markets. This is financial markets. And by growing vast market of green, including refi, because about 90% of financial instruments in financial markets are to do with refinancing existing things, then we make it easier or more attractive to grow new stuff to throw into this market. By the fact that we've got bond yields lower for green investments in Europe gives an incentive for utilities and companies to create new assets because they're financing cheaper and more plentiful. So we've got to understand that aspect of it when we start talking about impacts here. The concept of impact is different in this particular market. There is still a general question about what kind of things to do on the ground, which I'm going to case caught up in the taxonomy process. But in the bond market, the capital stack argument needs to be understood before we look at specific instruments and specific bonds and their impact on you. But hey, longer conversation there, Joe, and I'm looking forward to picking up with you. Iben, you've got to wrap up.
Certainly.
Thanks for the opportunity.
Yes, yes, thank you. I'd like to read out a comment from Binny, which is, are we ignoring the larger context in which climate bonds exist and operate in? The financial architecture is evolving fast and furious. Monetary and fiscal policies are merging. We are no more in the same world now as before the pandemic. This also means credit ratings, metrics, returns, and are questionable. So what is baseline, and ensuring it is as kosher as science-based targets? And I like to take one last question, which is on the potential for developing countries to benefit from green bond markets. Hisham asks, what are the priority actions and who are the key stakeholders that should drive their implementation for helping low and middle income countries overcome institutional, financial, and political barriers to expand and benefit from green bond markets? This is the last question. Joe,
Mine is a quick one. It should be, mine is a quick answer. It should be the likes of GCF and IFAD. We have the wherewithal, we have the country presence, we have the focus on enabling environments, and we've got the policy tools, right? And then we can have the likes of HSBC and ExxonMobil come in later. Thanks.
Thank you, Joe. Sean, do you have any last words before we close?
Look, our focus is not on Togo and Benin. I'm going to say quite clearly here, there's a development agenda there. Our focus is getting emissions down where emissions are happening. They're not happening in Togo and Benin, frankly. And so let's focus on what we've got to do. It's China, folks, and the US and a few other countries where we have to achieve things quickly. 1. 2 is, of course, for the least developed economies, there's got to be an angle on resilience as we go forward. It's going to become more and more of an issue. It's not going to happen through capital markets. If you can't issue a bond, get out of here. You're going to be relying on development banks. You're going to be relying on aid transfers. That's not going to change. But this is a tiny part of the world economy, even though it has huge social implications for populations. It's going to be addressed for the ways we've been trying to address it for years, although we've got to do better at it. But for a huge chunk of the world's economy, 90% of the world's economy, we can use its relationship between public measures and private capital to achieve drastic change and rapid change. We can do it. I mean, don't get me wrong, this is a race, and it's a tough race, and we're way behind. So it's not at all certain we can achieve this, but I think it's achievable. We've got the capital. The capital is sitting in places like the German Bunds, zero interest rate instruments. We've got more than enough capital in the world to reshape the whole planet. It just needs to be applied to the right place. We know how to do it. I'm reading a book on American credit market development at the moment. And since the 1830s, since the 1790s, in fact, the US has been using guarantee instruments to drive change. It is not a free market economy. It is an economy that's been driven by the government in public priority areas. That same model, which was also used by the China Development Bank in the 80s and 90s, simply has to be applied globally. That's it, guys. Private capital will be sucked in with measures that public sector agencies do, which can be fiscally efficient, can mean no borrowings necessarily. There's opportunities here. So this is my point, and that applies to mitigation and the large-scale resilience of major economies. It's not going to affect Togo and Dahomey. They're going to have to go to the West African Development Bank for help, who, by the way, is getting its act together very slowly. But so in every area, there's a solution. It doesn't mean it's all in this particular area. The key thing is the revolution has started. We're underway. I could place, if I could find them, $10 trillion of green bonds tomorrow. The generation of issuance now is the problem. What a fantastic problem to have. Unbelievable turnaround in 10 years. It is no longer the demand of investors. And of course, there are risk yield considerations. We need green climate fund money for risk mitigation in key areas to unlock markets, to get water flowing. But, we know what to do now, and it has started. And that's what gives me hope, because let's face it, it's not as if the science gives us hope, is it?
Thank you, Sean. We've gone way over time, so we have to close this meeting now. We have a lot of people in the chat box thanking the two presenters. I would also like to say thank you so much for joining us. This was incredibly engaging. Also, thank you to everybody who joined us for your questions. Before you go, we'd like to leave you with some IEU products. We regularly publish blogs on our website. The latest one is on the 6 steps of designing an impact evaluation. It's also available in Korean. We also, next slide, please. We also publish a podcast every month. The series is titled The Evaluator, and this month's episode is on climate and gender. Lastly, we recently published a learning paper on behavioral science. I encourage you to check that out if you're interested. It's written in cooperation with Busara Center for Behavioral Economics. Joe is also a co-author on that paper. And lastly, we will continue to organize IEU talks on topics that matter in climate change, sustainable development, and evaluation. Stay tuned for our next virtual talk on July 22nd. We'll be joined by a special guest from the International Finance Corporation. Thank you, and we hope to see you again.
Thank you.
Thank you.